we are live. Welcome everyone to another episode of Portfolio Talks, where we're bringing the conversations around money right to you at your fingertips on your phone. So the days of you being confused and frustrated that you don't know about money and the language around money, those days are done because you're subscribing, watching Portfolio Talks. If this episode gives you value, make sure that you like, subscribe, and share because it just motivates us and gives us good feedback to continue to do this in this kind of space to give you all free advice. I should always preface this by saying it is not financial advice from any one of us because we don't know you, we don't know your situation, and when it comes to finances, the best plan is the plan that makes the most sense for you and your situation. So take this with a grain of salt. This is going to give you a good platform for education, but make sure you talk to someone to figure out what makes the most sense for you. So that being said, you have the regulars. You got myself, Vishal, you got Tyson Nagasaka, and Michael Lloyd. Mike is joining us from Cold Kelowna. As you can tell, he's the only guy that I can imagine that would wear a button-up underneath the button-up. So it's like button-up inception, which is great. So good to have you guys. And we're going to be covering a couple of things today. One of them, we're going to be talking about the Canadian dollar as of December 4th, 2024. The Canadian dollar is going down. We'll talk briefly about that. We'll talk about investment vehicles that are outside the public market. So a lot of people used to do the sit and wait approach when it comes to buying the S&P 500, and that'll take care of your problems. That is not the solution it used to be anymore, and we'll talk about why. We're talking about alternative investments for high net worth individuals. So what should you invest in besides just public markets or in addition to public markets? And then really, how do you identify good investment opportunities? That's a whole spectrum of stuff, but we'll talk about that as well. So gentlemen, how you guys doing?
Fantastic.
Good. Just recovering from my COVID bout last week, but I'm on the mend.
Love it. You got that sultry tone in your voice, which is fantastic for our audience. So you guys are in for a special treat. It's a special episode right now because Mike's got that raspy voice going on.
Yeah.
So I guess I'll start off by just talking about the Canadian dollar and give some quick thoughts on it. So it's tough, man. It's really, really tough when it comes to looking at the impacts of the Canadian dollar for a bunch of different reasons. But generally speaking, the Canadian dollar is always behind the American for a bunch of different reasons. But the main reason is investors, international investors, just have a lot more faith in the American economy because of the history, the track record, the stability. Everyone uses US dollar for trade. So there's a lot more stability in their economy than other economies. So you're always going to be behind the US dollar. But how far behind is crazy. So as I don't know the exact numbers right now, but I think we're like 70 cents on the dollar-ish right now.
0.71 right now.
Yeah, so which is insane. So if you're planning to go to the States for anything, if you're in Canada and you want to cross the border for some holiday shopping, the deal might not be the deal you thought it was because you can just add on 30% on top of whatever you're buying. So, Boxing Day, you're saving 10%. Cool. You're actually, not saving 10% because you have to pay 30%. So, you're paying 20% more. Trader Joe's, all those runs across the border, and then vacation as well. It's important to understand for your budgeting perspective that you're losing buying power when you're going to the States right now. And it may get a little bit worse because there's a couple of reasons that we see the Canadian dollar and the American dollar fluctuate. So when it comes to Canada, the economy hasn't been good for the last several years. We are very, very chaotic when it comes to our economy. Everything is basically built into real estate, which makes our debt to income ratio like 180 or 190%, something insane. So you're spending almost double your income on your expenses. From an investor standpoint, if you look at that, like imagine, Mike, if you and I were going to buy a business and we're like, all right, well, how much does the business generate? $1 million. Okay, what's your debt obligation for the business? $2 million. Wait, what? Like you're losing money? Like that doesn't make any sense. So from a business perspective, why would they invest in the economy that's that much income to debt ratio? That's one thing. And the second thing is interest rates. You see the interest rates in the States are not coming down as quickly as they are in Canada. So if I had, $1 million, $2 million to invest, and I just wanted to get guaranteed income out of it, I would put my money where the interest rate is higher. And that's why you're seeing a lot more money go into the US economy as opposed to the Canadian economy. Hence why you're seeing the Canadian dollar drop and why you may see it drop a little bit more. So I say that to, stay on theme with this time. It's the holiday season. So if you're looking to cross the border to do some holiday shopping, probably not the best idea. And if you have some vacations planned in the January, February, that's right across the border, just keep in mind that you're going to be paying probably a lot more than you thought you're going to be paying. So That's my thoughts on it. Anything from you guys?
Yeah, I mean, we're in a secretive recession. Basically, Canada's been in a recession for a while. It's been covered up because of so much immigration coming through, but in reality, we're in a recession, and that's part of why, like you said, comparing. I mean, if you're comparing the Canadian economy versus the American economy, the Americans, the joke used to be if they get a cold, we get a flu or whatever. But it basically means that we're tiny compared to them. They're flexing their muscles right now, and they're getting. They know that Trump's going to make changes, regardless of whether you like him or not. So there's a lot more, I think, optimism that the markets will do better down there, and the economy will do better. And in Canada, we're kind of stuck in this zone of high taxes, lack of confidence. We're just not in a great place for people to want to spend a lot of money and get business going.
Yeah, yeah, 100%. On that topic about investments, I think it's a perfect segue to go into our next topic of investment vehicles outside of traditional markets. So Tyson and I had a good conversation about this yesterday, I believe. So Tyson, I'll cue this one up to you. When it comes to investments, the old school mentality, I mean, not even old school, this is like a couple of years ago, but the older mentality used to be just put your money into the S&P 500, basically the stock market. Just throw it into an index fund, buy a bunch of stocks that are in the public markets and just let it ride. And that will make sure that you have a good return on your investment and you can retire as per all your dreams and goals and wishes. So is that still true? Why or why not?
Well, the unfortunate thing is the like social media money influencer realm. They're going to continue to say just buy S&P 500 because it's cheaper in terms of like an investment vehicle. But when you listen to the chief investment officers of different companies, you listen to economists that are on the investment side of the industry, is they are kind of raising the red flag that like the traditional S&P 500 and the Nasdaq and the Dow Jones, the markets have become so increasingly concentrated. So the top, what do they say here? The top 10 companies in the S&P 500 represent 36% of the market capitalization, right? And so when you're that top heavy, if something changes, it's like Jenga, right? I mean, like the dominoes fall, and do you want to be the one holding it? We don't know. We don't know when the end of the road is for like Nvidia or some of these big companies that are really driving the market. But when it happens, it's not good. So when I started in banking, Michael remember this. When I started in banking, people were taking lines of credit out on their house to buy Nortel, and that was in like 2000 because it had had a spectacular run. And then all of a sudden, it went away. But now you've got an extra, $100,000 on your mortgage. And in 2000, that was a lot. That might double your mortgage.
Yeah.
And so now you have more mortgage and you have no stock portfolio. And so you have to take that with a grain of salt. So in terms of like the traditional buy an index fund, let it ride, you're going to make X amount percent. You could, but with that style of passive investing, you also may ride the market down and you have no downside protection. You have maybe no diversification. And this is where DIYers can get themselves into trouble.
I think to your point, Tyson, that you think about that 36%, like it used to be diversified because there was 100 stocks or 1,000 stocks. Now, if it's all really 5 stocks or 10 stocks, that's not diversification. That's like a mutual fund, basically. It's not,
Yeah, exactly.
you're stuck with what you got. So it doesn't make sense.
Well, what's funny about that too is like the S&P 500, it's still 500 companies, but it's driven by those top 10 companies.
Yeah.
And I know in 2023 they were saying the bottom like 50 companies in there, the bottom 100 companies, they really weren't performing that well. But you can't tell because the top performing ones were so big that it's just driving the entire index.
Well, and I think it also, just sorry, really quickly, but it also shows you, we know these NVIDIAs and these big headline things that have spiked and gone crazy. And so people think that's the answer. I got to have that. Whereas there's so many other companies that could be doing really well for you, or just chugging along quietly and doing their
Yep,
thing. Nobody knows
exactly.
about them. It's like the loud person is getting all the noise, and the other people aren't getting noticed, and that's dangerous too, right?
Exactly, exactly. So there's a bunch of hilarious things that are out there now because people can create their own indexes or their own ETFs. So we have like the Nancy Pelosi index because she's like the world's best insider trader.
Yeah.
There's the inverse Kramer index. So when Jim Cramer makes a prediction and they lose badly, fairly consistently, they're saying that that's outperforming the market right now because it's doing the opposite of his advice. So there's some hilarity that comes out of this, and I'm not saying that that's investment advice, but it's interesting to watch.
For sure.
I wonder how good the Simpsons ETF would perform because they predict everything. So if
Yeah.
there's ever an ETF, if there's a Simpsons one, I'm like, I'd be interested to see how well that one does. Uh,
Apparently, there is a Korean pop ETF, and I don't know how that monetizes, but there is an ETF for everything now, and to the point where they are running out of ETF tickers, and so they're actually auctioning off the last tickers that are available for ETFs because there's such a hot commodity. And so maybe we'll see a flush of these, non-profitable, non-functioning ETFs.
It's like how they used to sell domains back in the day. There was a bunch of domain resellers, so it'd be like Tyson at whatever, and people are like, all right, I got this one. Now that you make it big, I think there was a big thing about Justin Bieber. Like once he started making it big time, someone took all his domains and then they sold it back to him for a bunch of money. That used
Yep,
to be the thing. So that might be the next one is ticker resellers. That might be a big thing.
yep, yep. Probably
But
already
yeah, I
is.
think if you look at the stock market, exactly what you were saying, where the top 500 companies, let's say the bottom 100 don't really perform all that well, and then a lot of the top ones are really a monopoly. They're owned by several companies. What is that, 30%? So that's like instead of 500, that's like 380. Take away the 100 performing bad ones, that's like 280. So really, instead of 500 companies, you're investing in the growth of like 280 companies, which when it comes to diversification, that loses a bunch of it. So for those people out there, Mike, I guess we'll start with you. So yes, I understand that I'm watching this. I'm like, okay, well, maybe not throwing all my money to the stock market makes a ton of sense because you're trusting a few companies to handle basically everything and have nothing go wrong with them. But what's the alternative? Like, what are some other options out there for them?
Well, I mean, I always think people should invest in ways that are is exciting or interesting to them, at least interesting. I don't think people should just try to follow everybody else. They should have their own way of doing things. And, if you're passionate about certain things or portions of life, then try to find ways to maybe invest. I mean, you may not be able to go and buy $1 million house yourself right this second, but it could be something where we've mentioned before, you can invest in a mortgage investment corporation where they lend money and they're using real estate as a backing for that investment, but their returns are better because they're doing private mortgages like first and seconds that pay 8 to 12%. So some of those average, over 10 or 20 years, 6 to 10% in that range. So it's a little bit different. It's not exactly a stock market, but and I'm not saying that anybody should ever go all into that, but it's find things that you're passionate about and you find interesting, and try to diversify that way. I try to find different angles that you're going to want to look into, because this is your life. Like, you want to keep track of this stuff, and if it's boring and it's just some piece of paper that shows up once a year and you don't look at it, that's not helpful for you. You've got to be active, and you've got to be. I don't think you have to be on it every day, but I think in if you're gonna, it's your money. Like, you should be managing it regardless.
Absolutely. Tyson, what about yourself?
Yeah, I think to follow on to Mike's thought, um, is there's the philosophy of buy and hold, but buy and homework is so much stronger because you have to know what's going on. And I think that's a challenge with people who not to harp on DIYers, but they don't know when to get all the good stuff off the table and take profits off the table. And just because the going is good doesn't mean that it's going to last forever. And so that I think that's usually the downfall that I see with people who want to manage it themselves is they don't know when enough is enough, and you got to take some of that good stuff off the table and cash it in. And there's a strategy for that. But role of alternatives. We've seen a lot of really interesting. By the way, should we have a disclaimer? This is not investment advice. Please don't do this. But this is what's happening out there. We've seen since the start of the pandemic, so in 2020, the marketplace for luxury watches and cases of wine and a few other things really start to materialize as an alternative investment market. It went wild. And so I don't know if you guys have ever looked into like tracking the prices of certain like Rolexes or Pateks or any of those things, but the second market valuations that were out there were unreal. I mean, it was like, you could buy a house instead of buying some of these watches. And the sizzle on that market seems to be really tapering off, and some of the pricing today is about half of what it was in 2022. And so if you got in at the height of it, hopefully you got your money out, and you're not just kind of watching it go back to retail pricing. And so that's pretty wild. The other thing that Vishal and I talk to clients about a lot is having access to alternative investments. Then what that means is like private equity, venture capital. Sometimes they call them liquid alternatives. It might be infrastructure or private debt funds, and a lot of that stuff, it doesn't trade on the stock market per se, and so because of that, it's not correlated to market predictions. So whatever you see on the news saying, like they elected the wrong person, or interest rates are spiking, or inflation's rampant, your portfolio is trekking along outside of all of that noise, and it's underwritten in a certain way that you can have sort of predictable results. And it's nice to have that. So for our higher net worth clients is, you concentrate to get rich, and then you diversify to stay rich. And that's really like kind of the messaging that we put out there.
Yeah, that's really well said. And I think when it comes to, Mike, to your point about investing in things you're interested in, I think that's key. That's one of the things that will determine what makes you a successful investor, is just sticking with it. Because I can't remember which one you said it. I think it was Mike. You were talking about the uninteresting companies that just chug along and they're not out there making big noise, big news, and just hitting home runs, but they're getting good, predictable returns. And then what you're really doing is allowing compounding to work for you, because you're investing in these reliable companies that have good ledgers and they have good fundamentals of business, and they just keep getting profits over and over and over and over and over again. And your money is just growing and growing and growing, instead of hemorrhaging and growing, hemorrhaging and growing, and having a high turnover. That's really important. And there's so many different ways to invest inside your interest. So instead of taking, $1 million mortgage to try and buy a fixer upper, and now you have one bad tenant, and depending if you live in like BC and Ontario are infamous for their tenant rules, but if you have one bad tenant, now you're really stuck. So instead, you could just take whatever your down payment would be, like $300,000-$400,000 on that. You could just take that instead and buy a bunch of different alternative investments, and that can work out for you. Or maybe it's both. Like maybe you just buy elsewhere and then you put some money into a REIT elsewhere, or a mix. So there's so many different ways that you can do it. And then to Tyson's point, yes, I do remember the watches, but I also remember the used vehicles. That market was crazy, and then the deposits on like the Ford EV was insane. I remember everyone was buying the Ford EV pre-sales, and they're like, "Oh, okay, I can flip this later on," or whatever it is. The amount of vehicle deposits that were trying to get flipped was insane. And I remember at that time, I had so many people messaging me, and friends and family, being like, "Oh, should I buy this used car? The market's crazy. Should I buy this watch? This market's crazy." And I was like, "Stay away from all of this. It doesn't make any sense. It's never been a good, like at one point was like a Honda Accord a good investment opportunity. Like it just doesn't make any sense." When you say it out loud, it doesn't make any sense.
Yeah.
So I think that was one thing, that it was such a weird social experiment during COVID, that everyone was at home, and it's almost like everyone's bored and had nothing else to do. So they're trying to come with all these different things to keep their minds busy. So all these random markets all popped up, but it's all smoke and mirrors. And through that all, the things that have been the most consistent is, to Mike's point, the fundamental businesses that aren't flashy or trendy or any of that stuff. It's just good fundamentals of business. It's something that people need. It's something that has a demand, and it's run efficiently, and it just keeps getting you returns over and over and over again. So yeah, and on the last point about DIY investors, again, not to harp on them, but we had a bunch that were reaching out to us to get, insurance or financial planning or whatever it is. And oh yeah, I'm running my own portfolio and I'm getting like 30% returns. And as much as we try to talk to them, like, hey, like, this isn't going to be a long-term thing. You should look to diversify. They're like, no, I'm good. Like my portfolio's been killing it. And then right after COVID, they came back like, yeah, I lost like 70%. Like it's pretty much all gone because a lot of people know when to buy stuff, or you can just get lucky at when to buy. Like the market's down, you hear something, whatever, you get lucky. But the real difference is people don't know when to sell. And that's when you get into a lot of trouble because you're taking your profits, buying the same stock, taking your profits, buying the same stock. And then someone takes the ground out from underneath you and the whole house of cards falls and then you're left holding nothing. And it's a very, very tough situation to be in, especially if you're older and you have less room ahead of you than behind you. That's always important to remember. So when you work with a proper investment specialist or financial planner, like Tyson was saying, that actually gives you financial advice or investment advice, a lot of it is predicated on what's your risk, what's your timeline, what's your taxation position, based off all this other stuff. These are the investments that make the most sense instead of DIYers who just, I saw this online, I'm going to buy this investment. And it's almost like taking this square and trying to cram it into the circle spot, be like, no matter what, this is the best thing ever that's for me. It just doesn't make any sense. So take that with a grain of salt, but just make sure that you stay away. If it doesn't make sense, and I think all these people know the moral compass points them in the right direction. Like I know this doesn't make sense, but I'm just trying to like turn a blind eye to it because I saw online someone made money off of it. Listen to your gut. If it doesn't make sense for you, makes you feel super uneasy, stay away from it because there's so many other ways to make money, like Mike was saying before.
I think, and it goes back to value. If you're going to invest in things, invest in value. Don't invest because your buddy made a whole bunch. Like, it's great for sitting around a campfire and bragging that you made a whole bunch, but you'll never hear the story about when you lost it all. And the thing is that you'd rather be the quiet guy that never talks about what you invested in and just slowly accumulates, but in a really safe, but great way, because you bought value things. So value means like it's backed by value, or it's like you said, a good company that's just consistently been around 25 years and has made X amount every single year, and they can prove out why they do it, and you can see the system and why it works. If you're buying something just because you hope the stock price might spike because there's a lot of hype on it, that's not value. And I think that's where watches and all this other stuff that we got into, like, yeah, if you're basically in a pyramid scheme, so if you're the last one in, you're screwed. And if you can't control a pyramid scheme, so why would you want to get invested in something like that? It just doesn't make any sense.
Yep.
I've never heard of reference to the pyramid scheme, but that's exactly right. It's pretty much a pyramid scheme. So, the GameStops, the watches, the vehicle pre-sales. I don't even remember all the other ones that were out there, but it was just insane. But that's all the bad ones. So as we wrap up here, maybe let's wrap up with how to identify some good investment opportunities, because I know a lot of people, especially in our space, I actually got a message this morning from one of our clients like, hey, someone reached out to me about an investment proposition, want to run it by you. It's a lot. If you're someone that starts to have money and people around you start to realize you have money, you're going to get hit and inundated with a bunch of different investment opportunities. So Tyson, we'll lead off with you. How can individuals that are of higher net worth start to identify some sound investment decisions, whether it be alternative investments, public investments, private investments? Like, what's some thought process on that?
Well, I think when you are someone who has net worth, is you have to set yourself up. So there used to be something that I would talk about. It was called the 7 imperatives of wealthy families. And I won't go through all 7 of them, but one of them was for yourself, for your business, or for your family, you should have an internal investment policy. And that's like your internal rules and values for how you're going to invest. What are your expectations? And like we say to clients, what's the money for and when do you need it back? Because those should be guiding your investment choices. The next thing is this investment opportunity that you're being pitched, is it too good to be true? Sometimes, like you said, when you say it out loud to your advisor, you're like, oh yeah, Honda Accord, not a good investment. Now that I've said it out loud, everyone's making money, maybe it's not a good investment. So you want to have a sounding board. You want to have your financial team that you can go to kind of vet these things. And you want to know what is what is the management quality that's kind of behind the scenes managing this investment? What is the philosophy of the investment? Does it align with you? Right. So for somebody who's looking for, socially responsible investments, and then you look at the fund and it's, Boeing and Raytheon and a few other companies, you're like, oh, this is a war fund. This is not social responsible investing. You're going to make money, but it's not socially responsible. So it has to align with your values, and I think maybe bringing in your financial team and having one or two different sets of eyeballs look at it from different angles. So if I look at an investment and then Mike looks at an investment, we're on different ends of the financial spectrum, but we're both financially literate and we can kind of give you some feedback. And I think getting different angles of feedback before you lock your money in gives you a good idea about like pros and cons. And then I think the last thing would be liquidity. Should you change your mind and you no longer want to be in this investment, are you locked in for 10 years? Are you locked in until they sell the real estate? If you're in like a real estate fund, like what's your pivot point? And I think identifying pros and cons is a good thing before you lock all your money up.
And I think you got to be open to those opinions too. That's one thing to add. Like if you're serious about long-term investment, you can't bring something to the table and then people say this is absolute garbage and get offended and go and do it anyways. Then what's the point? Right? I mean, you've got to try and detach your feelings from things and be as unemotional about this stuff as possible, because you're dealing with a very emotional thing.
Yes.
You're talking about your family and your long-term, whether you're going to be living in a house or on the street. I mean, these are things that people can get really, really upset about pretty quickly, and nobody wants to lose. So I think being really, really trying to set yourself aside and treat it like a business, I think that's really important stuff too. I mean, we all want to succeed, but we all also have to be open to getting the right advice. And if you get the right advice, that'll save you. Saying no is way, way, way harder than saying yes. And the more successful and the bigger your net worth becomes, the more people are going to come at you with stupid ideas, and the more you're going to have to say no. And your time is going to become the most expensive thing you have. Money won't be that hard. Time will be. And that's where investing when you're 30 and you're starting to make a bunch of money is completely different than investing when you're 50 or 60. Now you're talking about tax implications and whether your spouse or whoever survives you, can they pay the taxes on what you've just created? And I mean, that gets into a whole different conversations. But I think you have to really, really try to set yourself aside from the taking it personal and treating it like a business.
Yeah, really well said. The only thing I would add is all that is true. And another thing to sprinkle on top would be having a good main investment. For example, if you have a good diversified portfolio, a lot of our higher net worth individuals, when people come to them with investment opportunities, it's not like they have the money in cash and they're like, all right, cool, I got this money doing nothing, so let me just give you X dollars and we can do something with it. It's usually invested in something. So I think having a good, really well diversified portfolio that has especially when you have money, that has an approach first of preserving your wealth and then also getting upside gains, like getting good returns on your investment. I think that's always good to benchmark your stuff against. So if Tyson comes to me with an investment opportunity, for example, all that could be true. We could have an internal policy statement. We could have checks and balances. We could have conversations, think of the pros and cons, the taxation, implications, liquidity, all that stuff. And even if that makes sense, if we look at what we're currently getting, it's like the rate of return versus the rate of risk. If there's something that I'm investing in a person and I can only get maybe 1 or 2% higher than what I'm getting passively in a well-diversified portfolio, does it even make sense for you to even make that decision and liquidate that money, move it over here, rebalance it? Probably not. So I think that's also really good, is to make sure that you have a main thing happening with your money, so you have a benchmark that you can measure this new opportunity against, is the only other thing I would add on.
That's great.
Awesome. So that being said, everyone, we hit our time. We always try and keep these around the 30-ish minutes. So if you're commuting to work, I think 30 minutes is a good commute. So you can have us accompany you on your drive, educating you, teaching you about all the fun stuff about money. So if you got value from this episode, please do us a favor. Give us a subscription, follow, like, share it, review it, talk about it, all that fun stuff. Because if you got value from it, I bet you anything, your friends and family and the people that you talk to on a daily basis would also get value from this as well. So that being said, we'll be back next week with another episode. Any questions that you have, any topics you want covered, feel free to let us know, and we will see you next week.